In this video, I'm going to talk about something that people get confused all of the time, and that is how much can you gift someone without paying taxes on it? Coming up next on Holy Schmidt.
Holy Schmidt!
Did you know that overwhelmingly people think that the annual tax-free gift limit is $10,000? And if you exceed that limit, somebody is going to pay taxes on that amount, whether it's the gifter or the recipient. And then there's the other group that think that the question is too complicated, so they avoid it completely. The reality is that the gift giving limit hasn't been $10,000 since 2001, 25 years ago. And the reality is that the rules are very clear, very specific, and once you understand the rules, you have a lot of flexibility, far more than people think they have. Today I'm going to show you the complete picture, the annual rules, the lifetime rules, and 2 exceptions that most people don't even know exist. These 2 rules are very useful for grandparents who want to gift to their kids and their grandkids. And finally, we're also going to talk about a banking rule that gets confused with the gifting rule a lot. Before we jump into the rules, I need to clear up a misconception, and that is if you give a gift, that person has to pay taxes on that gift. They do not. Gifts are not taxable to the recipient. That comes straight out of IRS Code 102. The IRS doesn't treat a gift like a paycheck. Your child, your grandchild, whoever you give the money to, they don't owe taxes on the gift, period. And they also have 0 reporting requirements. Now let's talk about the number that everyone needs to know. For 2026, the gift exemption is $19,000. That comes right out of the IRS Revenue Procedure 2025-32. Now what does that mean in practice? Well, it means that you can give $19,000 to as many people as you want this year. Your kids, your grandkids, friends, strangers if you want, I suppose. And not $1 is taxable, no forms need to be filed, and no reporting is necessary. The IRS doesn't even need to know about it. And if you're married, it gets even better. You and your spouse can each give $19,000 to the same person. They can receive $38,000 completely reporting free, no paperwork whatsoever. So if you have 3 kids and 4 grandkids, you and your spouse can give each one of them, 7 people total, $38,000 times 7. $266,000 with no tax consequences. And one more thing to note, this number has been increasing over time. In 2024, for example, it was $18,000. And if you look at the future, we'll probably hit $20,000 very soon. If you're using spreadsheets to manage your finances, you're doing it the old-fashioned way. You can miss a cell and get a calculation wrong, and that can throw all of your numbers off. I use, and we personally recommend, Bolden Personal Financial Planning software on this channel. In fact, I was using Bolden before they became an affiliate of ours. I liked them so much that I contacted them, asking them if our channel could be their affiliate. And right now, Bolden is offering 2 weeks free of their full-featured software. All you need to do is go to go.bolden.com/Schmidt. You can use our affiliate URL and get 2 weeks free. After that, it's $12 a month paid annually. So what happens if you want to give someone more than $19,000? Let's say you want to give somebody $50,000. Well, there is still no tax consequence to that in virtually all circumstances. Here's how it works. If you want to give somebody more than $19,000 or $38,000 if it's you and your spouse, then you, the gifter, need to fill out IRS Form 709. But here's the key distinction that most people miss. Filling out IRS Form 709 is not the same thing as paying tax on the difference. The reason that you need to fill out IRS Form 709 has nothing to do with the recipient or you paying tax on the gift. What it does is reduce your lifetime gift and estate tax exemption. And in 2026, that exemption is $15 million, up from $13,990,000 in 2025. And if you are a couple gifting, it's not $15 million per person, it's $30 million per person. So in the $50,000 gift to your son example, the first $19,000 doesn't get reported at all. The remaining $31,000 gets reported on Form 709. It also reduces your lifetime gift exemption for your son from $15 million to $14,969,000. For the overwhelming majority of people watching this video, Form 709 is just paperwork. It's not a tax bill. And here's where it gets interesting, and for some viewers, where they'll discover something new today. There are two categories of gifts that exist completely outside of the gift tax and gift recognition system. The first is college tuition paid directly to the college. So if you wanted to pay your grandson's college tuition for the next 4 years, you could do that, and none of that would count towards either the annual exemption or the lifetime exemption. And college, by the way, means education. It means if you pay for their college, their university, trade school, whatever the higher education is, and you pay for it directly, there's no gift tax and there's no Form 709. But the key word is directly. You have to write the check directly to the institution yourself. You can't pay your grandson, granddaughter, child and have them pay for it themselves, because then you don't get this benefit. And you could pay, say, $80,000 a year, for example, and none of that would count towards the annual limit or the gift and estate tax exemption. And the second is a payment for medical expenditures, doctors, hospitals, even the insurance company. If you do that, it's not part of the gift limits that we're talking about here today. Again, the payment has to go directly to the provider, but if you do it right, you could pay for someone's $200,000 surgery and not a single penny of that will count towards these limits. These two exclusions in particular are one of the most underused and powerful tools in financial planning. Grandparents in particular should really understand these. Speaking of grandparents, let's talk about a strategy that's particularly powerful for grandparents that want to make a meaningful contribution to a child's education and not directly to the university. It's called 529 Superfunding, and the way that it works is as follows. Normally, with a 529 plan, you're limited to $19,000 per year in contributions. But you can put all $19,000 per year for 5 years in at one time. You can superfund the 529 plan and take advantage of 5 years of time value of money. What this means in practice is that, say, a grandparent can put $95,000 into a child's 529 plan one time, and that funds the next 5 years. A couple can put $190,000 into that child's 529 plan. There are a couple of easy to comply with rules to understand. First is that if you do this, you do need to fill out Form 709 and just report that you've done it. And the second is that if you have any additional contributions, they go towards that individual's lifetime limit. So if you superfund your grandson or granddaughter's 529 plan, and then you subsequently give them birthday money sometime in the next 5 years, that goes against the lifetime limit. And the reason grandparents love this strategy, by the way, is that they understand the value of compounding. By the time they've retired, they've had the benefit of it, if they're giving this type of gift anyway, usually. And so they can give $95,000 per grandparent, so $190,000 in total if there are two of them, when the child is born, and that grows for 5 additional years. That's powerful, very powerful. And 18 years later, that could potentially pay for their entire college education. Time in the market does the heavy lifting. And just to be completely thorough on this, the gift tax provision covers anything of significant value. If you give them stock, if you give them cryptocurrency, if you give them rare art, all of it goes against the limit. And on any gift that you give that's non-cash, the recipient takes the original basis that you had when you transferred it. So if you transferred $15,000 worth of stock and you purchased it for $7,000, well, they will owe tax on the additional $8,000. And by the way, this isn't a reason to not give them stock, particularly if they're in a lower tax bracket than you are, but it's just something to be aware of. So up until this video, many people thought the gift limit was $10,000. And as I mentioned at the beginning of this video, it hasn't been $10,000 since 2001. So where does $10,000 come from? Well, it comes from something called the Bank Secrecy Act. It's a compliance requirement. If you deposit more than $10,000 into an account, the bank is required to notify the authorities that there was a payment of $10,000 or more. It's not a reason to not give someone the money. It just means that it's being recorded. That's all. The bank files something called a CTR, Currency Transaction Report, for any and all deposits for $10,000 or more. And so literally a national bank could have 1 million deposits like this in a single day. It's not a tax form and it doesn't trigger an IRS audit. It's something that just has to happen. But people heard about it and it became this data point. And somewhere along the way, people thought it was the $10,000 limit for gifting, and something bad happened if you gave someone more than $10,000. And to be really clear on this, there's absolutely no reason why you should ever break your gift into amounts less than $10,000. That's actually illegal. It's called structuring, and theoretically avoids the reporting, but it could send up another red flag, and frankly, there's no reason to do it. What I'm saying here is one clean deposit of any size is not a big deal. Just make sure you're not weird about it. Now, everything we've talked about here covers the federal exemption. It's $15 million, but occasionally, depending on the state you're living in, there is a state-level wild card that we should talk about. As of 2026, there are about a dozen states plus Washington, D.C. that have their own estate taxes, and some of them are quite low. For example, Oregon, the limit is $1 million before you start paying state tax on any gifts that you receive in excess of $1 million. Washington State is $3 million, Massachusetts is $1 million, and New York is $7,160,000. There are others as well, but the important thing to hear is to check with your own state to find out what the gift tax is. So the thing to walk away with here today is that the gift tax code isn't designed to punish generosity. It's just designed to track it. And for the vast majority of viewers watching this channel, the limits are probably quite a bit higher than you assumed they would be coming in. The $19,000 per person annual exclusion and the $15 million per person lifetime exclusion means that the vast majority of you won't be paying federal tax, you or the recipient, on the funds that you give and they receive. And I know it goes without saying, but I'm going to say it anyway. If you're going to give a large amount of money to someone, make sure that you run it through your retirement planning model so that it doesn't affect you in a negative way. Check out Bolden, go.bolden.com/Schmidt, and you can try their full-featured financial planning software free for 2 weeks. As I said before, it's $12 a month after that, paid annually. If you like this video, check out that video. Most retirees don't know that this Roth conversion window closes after 2028. This is Jeff Schmidt, and I will see you in that video right there.